monetary policy. Okay. Now in monetary policy, what are the important subtopics? First, you must know the meaning. Now, meaning does not mean that you just know the definition. So within monetary policy, or you can say meaning itself, there are so many concepts, and on what on you can say those concepts question used to come. So we'll discuss that also. Number one, meaning of monetary policy. Number two, we'll talk about tools of monetary policy. Tools of monetary policy. Now, this topic, I'll say that very important, or you can say you can put how many very in front of this. So, this topic is very important for your prelims. Okay. So, again, I am telling you that this is a prelims course. So, our focus will be on more prelims specific topics where question used to come. Okay. And I hope you have revised yesterday's class. Okay. So, if you have any doubt, you can send me anytime. So, you know my number. So, some of you have sent, so I have replied them also. Okay. Third, monetary policy committee. Monetary policy committee. Fourth, about RBI, or you can say role of RBI. Role of RBI. Fifth, measurement of money supply. So here we'll talk about your M1, M2, M3, M4. Okay, M1, M2, M3, M4, plus a very famous concept, that is money multiplier. Clear? So this is what we'll talk about, and then we'll talk about what is important for prelims is, that is types of monetary policy. Types of monetary policy. Now, once we'll discuss the types of monetary policy, so here we'll talk about types of fiscal policy also. Types of fiscal policy. Why? Because there is a relationship between monetary policy and fiscal policy. So then gradually we'll move to the discussion of paper and leftover topic of fiscal policy. So this will be the structure of today's class. Okay. So this will be the structure of today's class. So I hope this is fine with you. Okay, so we'll start with the meaning of monetary policy. Okay, so we'll start with meaning of monetary policy. Clear? So any doubt you can ask. Okay. Now one student is asking, sir, will you cover the recent conflict between state and central government on debt GDP ratio? Beta, this topic is important for mains. Okay, so again I am telling you that here we are for prelims crash course. So we have to stick to that only. Okay, no doubt this topic is or issue is important, that whatever is happening with respect to Kerala, okay, or you can say center state relationship. So this topic is, you can say, important from the point of view of polity as well as economy both. Okay, because you study about center state relationships in polity chapter or in polity portion, whereas when it comes to economy part, so there you only talk about borrowings. Okay, so ultimately this is what you have to understand. Okay, clear? So we'll start with you can say monetary policy, meaning of monetary policy. Now, meaning of monetary policy. Now, before I tell you meaning of monetary policy, now yesterday we have seen that fiscal policy means what? That is the strategy. That is the strategy to manage money with government of India. So we talk about in context of government of India. So yesterday I told you this is what fiscal policy. So I told you that government has 3 types of account. So they collect money in that. Okay. Now similarly, when we talk about monetary policy, so monetary policy is again the strategy with respect to management of money, with respect to management of money in market. So ultimately here my focus is management of money in market. So basically what I want to say, that if suppose we divide our economy, okay, if suppose we divide our economy in three parts, on one side government is there, okay, so assume that there is no state government, there is only one government, that is government of India, just for your understanding, okay, so assume this thing, one side government is there, on other side banks are there, and in between you can say private players, or you can say market, clear, or you can say people like you and me, okay, so we are here. Now this portion, that is whatever is the government, is managed by fiscal policy. That is what you can say we are doing in this. Now when it comes to monetary policy, so monetary policy is basically managing money in the market. So in layman sense we can say that whatever money in the market is, that we have to manage it, okay, that we have to manage it. So ultimately we are managing money supply, okay, money supply, that is through monetary policy, okay. Now here we'll understand the concept of first what is money supply, okay, or why it is important to manage money supply through monetary policy, okay. Now if you see like whatever money supply we have in an economy, okay, so whatever money supply we have in an economy or in the market in a financial year, now that money supply will decide the production of goods and services in a financial year. So ultimately what I want to say, that when we talk about monetary policy role is to manage money supply in the market, okay. So when I am saying manage money supply in the market, it means I am talking about this portion, clear. So we want to manage money supply in this area. Now the concept comes, why we have to manage money supply? The answer is very simple, because whatever money supply we have in the market in a financial year, that will decide your production of goods and services. So ultimately we can say demand supply equilibrium, okay. Ultimately the role is that whatever money supply we have, that will decide the production, means demand supply equilibrium. I hope you understood what basically I want to say or convey, okay. So this will ensure what? Demand supply equilibrium, clear. Because if in a financial year money supply increased, then this equilibrium will get disturbed, why? Because supply is limited, so I hope till here it is clear to you. So you have covered this thing in your foundation also, okay. So ultimately if money supply will increased, okay, it will disturb the demand. So ultimately every year RBI know this thing, that this will be the money supply in the market, and they will indicate to the companies that as per this money supply you must have production, okay. So if money supply increased beyond that limit, okay, it is going to disturb the supply, okay. No doubt some of you may be thinking that, sir, if money supply increased also within the financial year, we can increase supply also. Yes, we can, but to increase the supply we need time, okay. So if we will not give the time, okay, so ultimately what will happen, that increased money supply will disturb this equilibrium. So that is why it is important, to manage your demand supply in equilibrium, that is through money supply, that is by maintaining money supply. So concept is this, that every year or every financial year, so here concept is that in every financial year it is important to manage or to maintain, not manage, to maintain money supply in certain range, that is in financial year, okay. So that as per this money supply, companies will produce the products, okay. So you can say they will ensure the limited supply, okay, limited supply at some affordable prices, okay, at some affordable prices. So you can say people have their money in their pocket, so farmers know that this much quantity of rice they are going to consume, so accordingly farmer will produce rice. If money increased, or you can say people have more money and they started consuming more rice in a financial year, so farmer will say that I need a time to produce more rice, okay. But if you will not give the time, okay, so ultimately what will happen, production will get damaged, okay, production will, or you can say inflation will be there in an economy. So that is why it is very important to manage money supply, and when you manage money supply, ultimately then only you can ensure stability of prices or price stability, then you will ensure price stability, or you can say inflation, okay, you can say inflation. So ultimately the overall objective of monetary policy is to control inflation, okay, control inflation, that is by managing money supply. I hope till here it is clear to you, okay, I hope till here it is clear to you. If it is clear, please tell me yes, then I'll give you another question, or I'll ask you one question. Please reply. Okay. Okay. So ultimately, if this is clear, okay, so I got so now three questions for you. So you will answer it one by one in the order itself, okay. But I want those who are answering it, they must answer it all the questions, okay. So first listen the question. First of all, first question is that which or who is responsible for managing money supply, who is responsible for managing money supply in the market, who is responsible for managing money supply in the market. So what will be the answer, please tell me, who is responsible for managing money supply in the market. So please tell me what is the answer for question number 1. Question number 2, how money supply is managed. How money supply is managed in the market, okay. How money supply is managed in the market, okay. So this is the question number 2, okay. Please answer it. Just write answer 1, this answer to this, okay. And question number 3, will monetary policy manages all, okay, will manages inflation of all types, will manages inflation of all types, or you can say inflation due to any reasons, okay, all types, or you can say inflation due to any reasons, okay. So these are the 3 questions in front of you, okay. Yes, some are saying RBI is responsible, some are saying RBI, but beta, the answer is for the first question is, the answer for the first question is, the answer for the first question is that RBI and Monetary Policy Committee, RBI and Monetary Policy Committee are responsible for managing the money supply in the market. So ultimately before 2016, if suppose I was taking your classes before 2016, and you can say this way that if you are preparing for UPSC before 2016, then I will say RBI. But after 2016, we introduced MPC, that is Monetary Policy Committee. So we will say that RBI and Monetary Policy Committee both. Okay, so they are responsible for managing money supply. Clear? So this is what you have to understand first. Second question. Okay, so how money supply is managed in the market? So the answer is that is with the help of tools. Okay, that is with the help of tools. Okay, and we have two tools, quantitative tools and qualitative tools. So we used to manage with these two. Okay, and the answer for third, who will tell me? Okay. Okay, answer for the third question. Okay. Okay. So ultimately we can say when I am saying will monetary policy manages inflation due to all reasons. Okay. Although using the type word is wrong here. All reasons. So ultimately your answer will be no. Why? Because if you see monetary policy will help to only manages demand pull inflation. Demand pull inflation. So you can say monetary policy has a limitation. Okay, monetary policy has a limitation. So monetary policy can only manages demand pull inflation. So remember this thing. Clear? So if suppose in economy money supply is managed, means if suppose whatever money supply we require that we have in the in that financial year, but due to climate change there is a shortage of food grains. So ultimately there monetary policy cannot work. Okay, so there you can say role of you can say that that inflation is due to cost push, means shortage of supply. So there you can say the role of government will work. So there RBI and Monetary Policy Committee has no role. Okay, so if inflation is due to cost push, clear? Clear? So I hope this is clear to you. So can we say the complete meaning of monetary policy is, okay, or if meaning you have to remember that you have to remember like Monetary Policy Committee and RBI manages money supply with the help of tools in order to control inflation. So this is the complete meaning of, you can say, you can say which is the complete meaning of monetary policy, and here you can say demand pull inflation. Okay, demand pull inflation. So this is the complete meaning. Okay, this is the complete meaning of inflation. Clear? Now as I told you in the beginning that we have to maintain certain range of money supply in an economy. Okay, so whatever range we are maintaining, okay, whatever range of money supply that we have to maintain in an economy in a financial year, okay, the range of money supply that we have to range in a financial year, that there is a technical term used for it, and that technical term is known as stock of money supply. Stock of money supply. Okay, so you can understand this way. For example, assume that this class, if suppose in my class there are 500 students, okay, so assume that this class is you can say market, okay, or assume that this class is economy. Now whatever money you have either in your pocket or bank account, so when I sum total it, okay, so that is my money supply in an economy, okay, and I'll call that stock of money supply. Okay, stock of money supply. Now as per this stock, my economy will produce the products. Okay, but if this stock get increased or decreased, so there will be impact in terms of inflation. Okay, so we assume that if this stock get increased, so whenever this stock is getting increased, so we used another term that is flow. Flow of money supply. So again I am telling you, like in my class if there is 500 students, so please listen it carefully. In my class there are how many students? 500 students, and if I tell you or ask you that how much money all these 500 students have, okay, either in their bank account plus in their pocket, the sum total of that is called as money supply, okay, or you can say stock of money supply. Now my economy is producing product as per that, okay, my economy is producing product as per that. Again, okay, so ultimately whatever money 500 students have, so assuming that this is the economy and in my class there is 500 students, so ultimately whatever money you have, that is the stock of money supply, okay. Now if any one student from the 500 student gives money to any other student, will there be impact on money supply or not, or money supply remains same? Please tell me. Okay, if assume that any one student, if any one student gives money to another student, that is you can say there is a transaction of money, will there be impact on money supply or not? Okay, again listen it, if suppose any one student, okay, please answer it, okay, if any one student gives money to any other student, okay, will there be impact in the money supply or not? Okay, so answer will be it will remain same, okay. So it is this, when we are measuring stock of the money supply, we are measuring the total money supply in economy, we are not concerned with what an individual person is holding, हमारा उससे कोई लेना देना नहीं है, हम यहाँ पर ये देख रहे हैं कि टोटल मनी सप्लाई कितना है, किसी एक इंसान के पास कितना पैसा है हम उसकी बात नहीं कर रहे हैं यहाँ पर, क्लियर, किसी एक इंसान के पास कितना पैसा है हम उसकी बात नहीं कर रहे हैं, क्लियर। तो अल्टीमेटली हम यहाँ टोटल मनी सप्लाई देख रहे हैं, हम क्या देख रहे हैं यहाँ पर, टोटल मनी सप्लाई देख रहे हैं। तो एक तरह से इफ आई विड्रॉ माई मनी फ्रॉम द बैंक, ओके, इफ आई विड्रॉ माई मनी फ्रॉम द बैंक, ओके, एंड आई गिव इट टू समवन एल्स, एंड नाउ दैट पर्सन अगेन withdraw the money in any bank of India. So ultimately money supply is same. Okay. So if you have understood this thing, so once UPSC has asked the question that person X withdraw money from the bank, okay, so what will be the impact of money supply in an economy? So answer will be same, or you can say there will be no change in money supply. Clear? So ultimately this is what you have to understood. But there will be change in the money supply whenever there is a flow. Okay, there will be change in the money supply, or you can say there will be change in the stock. Okay, so ultimately there will be change in stock, whenever there is a flow. So can you tell me what are the reasons for the flow? So this is your next question. Okay, so can you tell me what are the reasons for flow? Okay, what are the reasons for flow? Anyone? Okay, so see, UPSC used to ask you a question on basic fundamentals. Okay, basic fundamentals. So this is what you have to understand, the difference between GK and GS. So this is general studies. Okay, so reason for flow. So if you see, when we talk about the reason for flow, so it can be multiple. Okay, number one, like as I told you, if 500 is the students in my class, and I assume that this is the economy, so whatever money students have in their pocket, okay, or plus in bank account, that is called stock of the money supply. And if they are transaction or doing transaction among themselves, there will be no change in the stock of the money supply, or I'll say that money supply will remain unchanged. Number one. Number two, if suppose some new student enter into the class, okay, or you can say suppose 10 students further enter into the class, so it means now the number of students are 510. Okay, so these 10 students that are entering in the class, so you don't see it as a student, see that money supply is increased, means flow is increased. Okay, so ultimately you can say if money is coming from foreign country, in any form, okay, in any form means if someone from India is taking borrowing, if someone from India is taking investment, if someone from India is taking remittances, whatever, in any form, that is going to increase the flow, or you can say reason for increase in flow. Okay, so you can say money coming from foreign country. Okay, money coming from foreign country. Clear? Okay, number one. Number two, you can say printing of currency by RBI. So yesterday we have seen that for borrowing purpose it is banned. Okay, printing of currency by RBI, whereas for other purpose it is allowed. But if we assume that RBI is printing currency for any purpose, either it is for borrowing or any purpose, so ultimately that is going to increase the money supply. Okay, number three, black money. So if in an economy black money is there, that is going to increase the money supply. Money laundering. Money laundering. And number five, counterfeit notes, that is fake notes. Clear? So these are the five reasons for increasing the flow. Okay, but why I have written in different colors? Because if you see the first two reasons are traceable. Traceable means whenever any foreign, you can say money is coming through foreign country, that is into our country, so that has a record with RBI. Okay, so RBI has a record for that, ki how much foreign currency is entering into our country and how much it is going. So if suppose X dollars are coming into my country and at the same time X dollars are going from my country, so then there will be no change in money supply. But if suppose X dollars are coming into my country but very less than X are going outside, or you can say no money is going outside, okay, then you will say money supply will increase. So ultimately RBI has a record for that, that is in the form of balance of payment. Now similarly printing of currency by RBI, so ultimately currency has to be printed by RBI, so RBI know that by printing how much money they are putting into the economy. Okay, so this is what they have a record for that. So ultimately when they have a record for that, so it means they can manage money supply easily. Okay, but when it comes to black money, so for black money RBI has no record with them. Similarly money laundering, there is no record with RBI. Okay, so through black money, money laundering, how much money has entered into our economy, we don't know. Okay, and similarly counterfeit notes. So counterfeit notes means fake notes, nakli notes. Okay, so if suppose like there is one web series, Farzi web series, so you have seen that if money is coming from fake notes, okay, fake notes, so by the time you identify the fake notes, they have disturbed our economy. Okay, they have disturbed our economy. So ultimately this is what you have to understood, that these are illegal methods. Okay, these are illegal and you can say they are non-traceable. So we basically not to use illegal word. Okay, so our concern is that these are non-traceable. So ultimately something which is non-traceable. Okay, so for that how RBI came to know that how much repo rate has to be increased and how much repo rate has to be decreased, जो हम देखेंगे अभी tools में. Clear? So this is what is the main concern. So can we say that monetary policy can only manage that money supply which is traceable? Okay, can we say that monetary policy can manage only that money supply? Okay, they can manage only that money supply which is traceable. Clear? Which is traceable. For non-traceable, okay, we have, or you can say monetary policy has a limitation over that. Okay, monetary policy has a limitation over that. Okay, so ultimately I have given you two. If suppose in UPSC prelims they ask you the limitation of monetary policy, so number one that you have to remember is that monetary policy can only manage demand pull inflation. Okay, but when it comes to cost push, structural inflation, that will see in inflation part, so their monetary policy has a limitation. Okay, number one. Okay, number two, Number two, monetary policy can manage only traceable, monetary policy can manage only traceable money supply. So when it is come to non-traceable, so there is, you can say, monetary policy get failed. I hope this is clear to everyone. Please tell me. Okay. So ultimately I am telling you the limitations also. So we have to be ready in all form or all format. Question can come from anywhere. Okay. So you can say limitation. So when we talk about limitation of monetary policy, so we can say number one, that it only control demand pull inflation. Okay. Demand pull inflation only. Okay, so nowadays some people used to give this statement like this, ki if only word will be there, that statement is wrong. Okay, so if you see in this statement we are writing only. Okay, and yes, because you have covered in your foundation also. Okay, so ultimately you also know that when it comes to cost push inflation or structural inflation, their monetary policy has no role. Okay, so ultimately here only you can say demand pull inflation only can be managed through monetary policy. Okay, because reason for demand pull inflation is money supply, and that is why monetary policy is successful here, and that is in this way. Okay, and second, okay, money supply that increase through traceable sources, so it can control that only. Clear? So this is what you have to remember with respect to monetary policy. Okay,